And welcome to my weekly macro update video. So today I would like to go over 10-year yields because that has been in the news. I also mentioned that in my previous week's market macro update video. So it has kind of gone much higher this year, and it's looking like it's on a path upwards. So I would like to go over that, why I think it might be going up, where it might end up, and what are the market implications? How will it affect? 10 years has a huge market implication. 10-year yield has a huge market implication. So let's go over that. So let's look at money supply velocity, M2 velocity, we call it. Let's look at that, and I'll build my narrative on why I see it going up uh, and where it might end up. So this is M2 money velocity chart. So this is a very long-term chart, and when it's going up, the inflation is going up. Basically, people transact more, or they spend more when they see inflation expectations. So inflation expectations have been high after COVID, as we all know it, and inflation expectations, if you look at, like, starting July 97, they have been going down. This is US, guys, but it's mostly true for most of the developed countries. So and you see, deflationary pressures building, and Fed has been fighting kind of deflationary pressures all throughout, last two, almost 3 decades. So um, so as this velocity went down, there were, deflationary pressures, and then COVID happened. There was stimulus, there were rate cuts, uh, there were zero interest rates. And then, inflation kind of picked up. It kind of broke out of this channel, and now it's decisively broken out of this channel. I see a good resistance here, and guys, this is basically up until July 2024. So this is almost like lagging 3 quarters, and this is a 3 month chart. So this is behind by, like, almost 6 months. So lately, there has been these uh, narrative in the news saying that, Fed might again consider raising rates instead of cutting, because it's not able to control the inflation. I think news cycle lags the actual markets. I think this particular chart probably already hit this point, and if it's not hit, I think it will hit in the first quarter of 2025, and that's when I see deflation kicking in again. There will be a round of deflation. It'll go down. So this probably, already has hit this mark, and then I see it kind of, falling back up until, somewhere in 2026. I think prices will continue going down. I don't know how intense this deflationary cycle would be. According to technicals, it should go and retest this channel. I don't know if that will happen, but then again, inflation will take off. That's how I see the inflation going. So around April 2025, I think you'll start deflationary pressures. That's when you will see a lot of layoffs in blue collar jobs as well. I'm kind of went over this in my USD update video. So you will see a lot of employment pain in 2025. So deflation is not good for employment. People get laid off. Business outlooks are they are not that good. So now, why is this important and why is it taking off now? So if you see, guys, these arrows. So this is from the peak of 1997 till, it's we see a significant drop in inflation expectations and velocity of money uh, at this point. So if we take the measured move and project it from this point, again, this length of this vertical lines are exactly the same. So this red line that you see is exactly the same length as this line. So if we project that, we go all the way to July 2034. Now 10 years are, they are looking forward 10 years. uh, that's why they call bond market a smart money, because they look forward much forward in time than stock market. So this is looking 10 years forward, and then they say, okay, yeah, looks like inflation will take off and break this barrier by 2034. So now what they do is they say we need more risk premium for these 10-year bonds beginning July 2024. And if you go to US 10 years yields, look at this. Look at this. Let's go to monthly time frame here. So starting July 2024, uh, you see, usually when market before it takes off, it just basically, shakes everyone out. It shook everyone out here, tested the lower end of this channel, and then it just broke out of this. So this means that market senses much higher inflation uh, going forward during next 10 years. And at the time, during in 2034, around in the second half of 2034, you will see some kind of a major reset. I don't know if it's going to be a dollar. I don't know what it's going to be. No one can see that forward, and it might be a culmination of things, but that's what market expects. And in the shorter term, again, if we go back to M2 velocity, the shortest period here is between this high and a bounce here in April '03. This is when Fed aggressively started cutting rates, and then this is when the housing prices took off. This is the housing frenzy of 2008. That this is when the seeds were sown for that. Um, so if you look at that and then project that time from this line, this is where it ends. It ends in October 2026. So if you see up until October 2026, you will see a major deflationary pressure starting first quarter or immediately after in the second quarter of 2025. So you will see, everything, prices, all the prices falling, including housing and everything. And that's the reason why in my 10-year yield projections, I say up until July 2026, the rates will be at 6%. And then from there on, within next 2 quarters, it'll hit 8%. And this is a uh, big shoot up, guys, because we measure bond prices in basis points. That is, one tenths, 100s, and that has major implications on markets. And imagine those going up, 2%. Forget about basis point; it'll shoot up like 2% all the way close to 8%. This is another strong resistance point, and I think this is where they will end up by the end of 2026. But so this is why I think this will happen, and my whole narrative behind um, 10-year yields going much further up. And so let's come to what implications this has. So this has a major implications on housing market, and housing market is really a huge market. Um, so housing market is in a standstill right now, and if people are expecting prices to go up, that's not going to happen. Also, 10 years going forward, I don't think you will see much price appreciations. People have been, used to year over year price appreciations. They think this is a temporary thing. It'll again start going up, but I don't think so. When there is risk-free return available at 8%, 8% risk-free return is available, no one will, no one in their sane mind will invest in real estate and, take that risk with all the climate change and, higher insurance rates, higher property taxes. I don't think real estate will be a lucrative investment going forward in 10 years. Yes, people who already own real estate, they will see increase in rents, so they will be fine. But people who expect to buy now and think that 10 year down the line it will compound, or even at like 2 3%, I don't think that is going to happen. uh, Risk free return does matter, and it does have its own implications. So I see housing prices, they are going to stagnate and even come down if there is a exogenous event. And I do see that, it's been a while since we saw anything. This happens once every 10 years. So also, it has its own impact on asset prices. So let's leave that for another time to discuss. But I don't see home prices appreciating, especially in US, Canada, and Australia. Why do I say that? That's because we have already looked at 10 years US. If we look at 10 years Canada, US 10-year, Canada 10-year, US government bonds. This has also again like broken the trend. This is a multi-decade trend, guys. This has broken that trend. It came and retested it. Canada is much further ahead in this whole cycle. Um, so it tested it. So this marks pretty much the bottom for their 10 years. So there, most of the people's lifetime, they won't see anything of this kind of rates again. So mortgage rates are going to go up as this goes up. So Canada housing will be, I don't think it will appreciate. Same thing with Australia. So if you see here, Australian 10-year, this also has broken a long-term trend line. This has broken out. I don't think new highs are coming to Australian housing market prices. Once it breaks this looks like a pretty good area of resistance. It's hit that. It will probably be a matter of time before it breaks out of this. Um, so so that is where I see 10 years going. I think people are making a big deal at 5%. Wait till it hits 8% sometime, next year. So that is my macro update, guys. I think this um, whole thing is of huge significance. That's why I wanted to go over this. So yeah, that is my update. I'll see you guys in my next week's macro market update. Until then, have a good weekend and bye.